Hello and welcome to the Chamber of Music Mindset. My name is Anna Rathbun and I am your host. This video series is, and for those of you who have watched it, you know what I'm trying to do, hopefully. For those of you who are new, this video series is really a pet project of mine. Um, it is my belief that if we all understand better what's happening around us, then we can make better decisions. And this is really about the individuals out there. This is really about the empowerment of Americans and sort of democratization of ideas. I like to boil big ideas down to bite-sized nuggets. Hopefully, I'm accomplishing that in these weekly short videos. Um, and sometimes this was my issue when I was just, living my day and watching the news. Um, News comes in headlines and snippets. And sometimes at the end of the week, it's really difficult to understand what's going on other than my emotional reaction to it. And that's not healthy. And that often takes us away from what is actually happening. So it is my desire in these videos to help you understand or at least share with you what I'm seeing that I think is important for all of us to know and to keep up with. So that's what this video series is about. But because I own a registered investment advisor, I have to tell you that this video is for information purposes only. None of this is solicitation and none of this is actual investment advice. Okay, let's start with the market update. Markets went up. In our industry, we have something called the markets melting up, as if it's like melting down. It's going up and up. Even if we have a sell-off day like we did last Wednesday, by Thursday, boom, we're back up. So there's a lot of enthusiasm among investors. And here are some examples of that. One, small caps outperformed large caps. Again, I've actually said this many times. Whenever you have smaller, less stable companies outperforming larger, more stable companies, it means that investors are willing to take a little bit more risk with the smaller companies. Never mind the fact that about 40% of the small cap index, the Russell 2000 index, is not very profitable. This is actually not a now phenomenon. This is actually almost all the time. There are questions about numbers of earnings numbers, and PE ratios are like almost impossible to really know at an index level for small caps because of it. That's why when it outperforms large caps, it actually, is a signal to me. The other thing was, I don't know if you guys were impacted by the Amazon internet outage, AWS, but it didn't matter that there was an outage, and Amazon actually took a while for it to actually identify the glitch and actually fix everything. It didn't matter. Amazon stock kept going up too. Like everything just kept going up. And lastly, meme stocks are back. So I don't know if you remember a few years ago, I think his handle name was Roaring Kitty. He was, I believe, behind the phenomenon of GameStop just prices just soaring. And for those of you who are not familiar, meme stocks are like, stock names that appear in a meme and it becomes viral and then people just pile onto it. And it becomes sort of the darling of this group of investors that like to do this. So what people do is they just pile onto a name and the stock price just soars, and sometimes it goes down just as fast. This is not healthy at all. This time around, the meme stock, before it was GameStop, this time around, it is Beyond Meat. It is plant-based food product that is supposed to feel and taste like meat. Not really my kind of a thing. I like my meat. In 3 trading days, just 3 trading days, because of this piling on phenomenon, not GameStop, Beyond Meat stock price increased by more than 600%. This is not normal and this is not healthy. The price of a stock is an expression of how people think of the world, how people think of that company, how people think of the investing environment, the markets, and actually placing trades based on those beliefs. Okay. And when you aggregate all of those trades, it is expressed in a single number, and that is the price. Okay. That's why we talk about the markets being smarter than any one of us, because it literally is smarter than all of us individually, because it's the wisdom of the masses, right? But when you have coordinated piling on of investors of assets into a single stock, and it moves up and down based on those herding mentality, that is not what the market is. That is not the spirit of the market. That is not investing. So what this tells me is the fact that people are comfortable doing this. People are comfortable doing this with money, their own money, and sometimes with borrowed money. Okay. And that means that they are loving the risk, and it is truly a risk on environment. Okay. So that was basically the environment last week, and markets going up. On the trade front, we have a few updates. I'm sure you heard about Canada. There was a video up that was very displeasing to the White House, and the trade talks have been halted. I am sure it's going to rev back up for two reasons. Number one, Canada's our friend. Okay, we live in a pretty uncertain geopolitical environment right now, where we're all wondering who's friends, right? Canada is an ally. It is a democracy. And second, Canada is a huge trading partner to the United States, um, partly due to proximity. They're right there. I live in Northeast Ohio. If I look beyond Lake Erie, I might be able to see Canada. Okay, they're our friend. They're close. They're like either first or second or third trading partner for the last, I don't even know how many years, for a very, very, very long time. So this is a very, very important trade conversation. So I don't think this is going to last very long. I think it's going to be fine. Australia last week announced with the US a partnership on rare earths. Australia is a continent that is really rich in minerals and commodities. Okay. So it makes sense for US to partner with Australia. Now, what is interesting about this isn't so much that the US would partner with them, but that Australia would partner with the US. Let me explain why. Australia and China have been very, very close uh, uh, trading partners for a very long time. In fact, as China's economy started to boom after it joined the World Trade Organization in 2001 or two, um, Australia supplied all the commodities. So as long as China was doing great, Australia was doing great. I don't think you'd had a recession for nearly 30 years. Maybe not even until like China's real estate started to go down, or until the pandemic hit. So that trading partnership is very, very close. And Australia was the beneficiary of China's economic boom. So it's very significant that Australia would announce such a deal on rare earths, the very leverage that China has against the United States, and announced this with the US as we are going into trade negotiations between US and China over the weekend and into this week. And President Trump is getting ready to meet with President Xi. The timing, the nature of it is very, very significant in my mind. What is it saying? It's saying, okay, you made us angry too. You made a lot of people angry, China, by putting such ridiculous export controls, just controls in general on rare earths. So you're going to do that. There are going to be other partnerships that are going to be formed. It's not unlike us putting a lot of tariffs, like really high tariffs, and other countries starting to talk and trying to figure out how to trade with one another. So a lot of this is posturing, I know, but it's real too. But I just thought that was significant going into this week. Okay, let's talk about inflation print, because that's another aspect of markets going up. Is that inflation print, the CPI came in lower than expected. Sorry, I'm having technical difficulties. The CPI came in lower than expected, and that increases the probability that the Fed is going to continue on its path to cutting interest rates toward normalization. So what did it look like? We were expecting, let's see, 0.4% month over month for the headline CPI. That includes energy and food, but the number came in at 0.3. We're expecting 0.4. The number came in at 0.3. On the core PCI, which is excluding energy and food prices, the expectation of month over month was at 0.3, but instead we got 0.2. So on both of those fronts, the numbers were more friendly. On the year over year, so from measuring from last year to this year, last October to this October, the number we were expecting was 3.1% for both headline and core. And for both of those numbers, we actually got 3.0%. So all the numbers that came in were below expectations. Markets were super happy. Markets are basically pricing in almost a sure thing of a Fed rate cut this week. I mean, I'm recording on Monday. We're going to hear about it at 2 p.m. on this Wednesday. The markets were very, very excited. Inside of the CPI, without going through every single item, one thing I will note that is very significant is the services side of CPI went down. Remember, we have the goods and services, right? The services is very, very sticky because I used to say, how often do you see your dentist saying, hey, 50% off every service? That doesn't happen. So services tend to not, have the prices go down. It only goes up. But that went down because rent increases are coming down. Okay, that is very, very significant, especially for housing market, especially for a lot of people. Next time you sign a lease, hopefully it's not as high as before, the year before. Okay. The other side of it is goods. So the services was really good news as well, but the goods is really good news. We got good news because that's where the tariff impact is. The tariffs are taxes on goods. So if you're expecting tariffs to actually raise prices everywhere, you would see the goods prices really go up. But it came in at 0.2% month over month. That's not very much. Okay. So it seems like tariffs are having a muted impact on the goods prices. And overall, we're around 3%. As I said, and so anywhere between 2.5 to 3% is probably where we will settle. And that gives a lot of confidence to the Fed that the tariffs are not as inflationary as they had expected. In the meantime, labor market is softening. So maybe they better go ahead and continue to cut toward normalization. So this made the markets very, very happy. It made me happy. It should make you happier than otherwise because the prices, some of the prices are, it's really high. It's really high. A lot of people are worried about price increases for 2026. And in the next video, in the next section, I'm going to talk about American consumers and how we're doing because we heard from various sources, even though the government is shut down, about the big picture of what American consumerism actually looks like. Okay, last week we got some information up on the consumer base as well as the broader economy. The Federal Reserve has something called the Beige Book, and it's really a survey of the businesses around the different Federal Reserve banks around the country. And it sort of gives us a pulse of how the businesses are doing, how they're feeling, et cetera, and whether they're expanding or they're neutral or contracting. It's not too different from PMIs, but it's not a diffusion index technically. What caught my eye was that under 20% of the American economy seems to be expanding at this moment, which means over 80% of the American economy may be either staying put, stagnant, or contracting. That's not necessarily a good sign, but it also may have to do with how people feel because these are surveys. If you still have tariff uncertainty and you still have higher prices, you still are experiencing a lot of higher prices and difficulties in your own life, right? That can actually have an impact on how you feel about the business, right? So there's surveys are messy that way. So I would take it with a huge grain of salt, but that did pop out. The others are really, it pertains to individuals, the American consumers. So, two earnings reports from last week. One is from Procter and Gamble. What did it say about the American consumers? This is a quote: "Not great, but stable." Okay, not great, but stable. That's not necessarily what we want to hear. We want to hear that we are great beyond being stable. If stability is, a high bar that we are having a hard time reaching, it doesn't bode too well for us. Um, According to P&G or Procter and Gamble, everyone is looking for value. Now, it has been this way for several years. Ever since prices really started to go up with inflation in 2021, everyone has been chasing value, looking for, how do you stretch this dollar a little bit more? But people are doing it differently. So if you're a high earner, you're buying things in bulk because, first of all, you can afford to. And secondly, per unit cost of what you just bought is lower, right? So that's how you're saving money. But if you are not a high earner and you're having a harder time, perhaps living check to check, paycheck to paycheck, then you are buying smaller quantities because it's a smaller hit to the wallet, even if the per unit cost of that is higher. So that is what Procter and Gamble is noticing. Everybody's hurting. Everyone's looking for value. On the other hand, Decker's Outdoor, the stock actually fell 15% because they actually provided softer guidance on their sales. Now, what do they make? They make, Hoka shoes. I actually own a pair, and I can walk miles and miles and miles in them. They're very comfortable. I know a lot of my nurse friends also have them. And for the really cool hip folks, they also sell Uggs. I've never had Uggs. I'm not that cool. So these are more expensive items, right? And their sales guidance was much lower. This is a sign of a very, very cost conscious American consumer. And the story lines up pretty well with Procter and Gamble observations. Now, I mentioned people living from paycheck to paycheck. This is that's 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 a place where if something goes wrong, it can mean that you're going to miss certain payments, right? And we are hearing about those things, and in particular, rising loan delinquencies in car loans. Okay, so according to Fitch ratings, 6.43% of subprime car loans, these are subprime borrowers for cars. I mean, the interest rate is super duper high for these things. 6.43% of subprime car loans were 60 days delinquent. And the highest ever recorded was 6.45. So it's pretty much there, right? 6.43, 6.45. And that was just January of this year, right? This is a record high. And another note, according to Recovery Database Network, there's the cars being repossessed in terms of numbers. We are also at a record. This is tough. This is really tough, and it's not surprising that we got the University of Michigan Consumer Sentiment Survey, the final tally of it. It came in even lower than expected at 53.6. We haven't been the survey hasn't been this low since when the tariffs first were getting started and everybody was nervous. And before that, it was when the Fed started to raise rates really quickly. So we're not feeling that great. And frankly, I think the cost of what we are buying, even staples that Procter and Gamble sells, that we're trying to find value in it. Everyone is searching for value. Value is great if you happen upon it. Value is a must when situations are difficult. So this is in all not the best. It's not the best situation for American consumers. There definitely is a K-shaped economy. of the leg going up, or this way, leg going up. People are, they may be looking for value, but they're fine. But the leg going down, there are people who, it's a challenge. And some people call it two different economies that we have. That's not ideal. That's not ideal. This is one of the reasons why I've been a proponent of the Fed cutting rates, because if you aggregate everybody's situation, you end up with an average that's pretty high, that's being pulled up by the higher earners. And then it looks like America's doing fine. But if you look under the hood and look at the different types of people and different, places, even geographically, you find a different narrative, right? Different picture. And so the high interest rates have been, disproportionately hurting a certain segment of the economy. And I do think that cutting rates is going to help that situation. So that's on the American consumers. Here's the thing. It's a really weird market. Not only does it keep melting up, feels like every bad news, there's a sell off and then it keeps going up again. And then every good news, like today, we're making progress with China, it's still going up. So there's no rhyme or reason, it feels like, as to why the market does what it does. And there's a lot of concern right now about high valuations, high prices of stocks. Is it a good time to invest? Some people are saying no, etc. Um, Despite all of that, investing is different. Investing requires discipline. Okay. And investing requires a different benchmark. And that benchmark is your life. That benchmark is your circumstances, your tax profile, it really is specific to you. So it's not about putting all your money in the stock market and then, having it go up. It's not about just owning one stock and having that, double, triple over a long period of time. That's not what this is. Investing is really about. Investing in many ways is removing the emotion out of the investing practice and being strategic, disciplined, and always having a long-term view. That is a really, really important part of investing. We tend to get emotional about money. All human beings do, right? Removing that emotion is very, very difficult, but it is a necessary thing when it comes to investing. And with that, I'm going to end today's video. Hopefully next week, I know we'll talk about the Fed policy, because I know for a fact we're getting that on Wednesday. Hopefully we'll have some government data to talk about. The longer we go without a shutdown, without a resolution there, the more mysterious the labor market becomes, because we just don't have the data from Bureau of Labor Statistics. So that is my wish, for the government to find a resolution and to end the shutdown. Have a wonderful week, everybody.